Wall Street Bets has everybody thinking that you should buy really cheap, out-of-the-money options right before stocks announce earnings. They always talk about how they make thousands of dollars on their gains when they're right, but what about when they're wrong? What about when they're even right and they still lose money from doing that? Welcome back to the channel. I'm Jacob Fisher and it's Minute Monday, which means we need to answer the question, should you play earnings on options and how should you do it in just a few short minutes? Remember, I am not an investment professional, so this is for entertainment purposes only. With that said, let's tap the like button and get into it. The first question to answer is, should you play earnings on a company? Should you buy way out of the money options when a company is going to announce earnings? And the answer to that is no. You are pretty much giving yourself a 50% chance of being right. And even if you're right, sometimes you can still lose money. This can happen if the IV crush or if the IV implied volatility drops too heavily after earnings, and if the stock doesn't move as much as the IV was predicting. Let me just explain how that works really quick. We use Tesla as an example because it announced earnings the other day, and it's always a great example for this. Tesla had expected earnings of negative $2.35 a share, and then when they reported, they had $2.18 earnings per share. That's in the positive compared to the negative, so they really beat earnings. Earnings was quite the beat, but IV was so high, I believe it was anticipating a 400-point move when they announced earnings, or by the end of the week, by the time the contract expired. Tesla closed at $15.89 the day before earnings, and the next day it opened at $16.78, so we still got a nice 100-point move on Tesla. Now, if you wanted to buy these 1,700 options, you could have done that, but for $100 the day prior. When Tesla opened the next day at $16.78, those 1,700 call options actually opened up at 75 because of the IV drop. Now I know what you're thinking, Tesla went up 100 points, so why did my option value drop? Well, that's the IV crush I was talking about. You could still be right when you get earnings for a stock, but you can still lose money because of the IV. You can play earnings in another way though, one that has a much higher likelihood of making you at least a little bit of money. You just have to play the earnings run-up. Tesla is insane. You could check out the chart for yourself to see the run-up for earnings. So let's check out another example, Apple in this case, who just announced earnings the other day, and considering they're announcing a new 4-to-1 stock split, we're just going to use them for this example. Apple announced earnings on 7/30 along with a handful of other tech stocks. Now they beat and they had a great earnings report, but we're talking about the run-up here. About a week prior, Apple did not have such a good day. In fact, the market did not have such a good day, but the next day after that, it recovered a little bit. Getting in during that little recovery is a much better bet than trying to catch a falling knife, as I would say, by trying to buy call options for Apple when it's just dropping 8%, 5%, whatever percent it was down on the day. The 390 calls were trading from a range of $1.86 to $3.71 on the 24th of July. We're talking about that recovery day here where I think it's safer to get in than, again, trying to catch a falling knife. Let's say you notice Apple is making higher lows and you decide, oh, let's get in some call contracts prior to earnings. Now you could have done that right around $2 a contract. The next few days leading up to earnings, Apple increases in price like a lot of stocks do, but it also increases in IV, which inherently pushes up the contract that you bought even more. Since Apple is increasing and your IV is increasing, your contract is increasing in value a little bit faster than it normally would. If you waited until the day before earnings, the 390 call contracts had a range of $2.32 to $4.89. At any point in the day, you could have sold your contracts and gotten out with a decent gain by profiting off of that general rise before earnings and the increase in IV that helps to boost you along your way to making more money. Selling before earnings gives you the ability to not have any risk on the table no matter what they announce for earnings. You just profited off of the rise up for earnings. Now, Apple did go on to crush earnings and spike a ton, but what if it didn't? Or what if it only moved up a little bit? You probably would have been out quite a bit of money, well, depending how much you had spent on the contracts. Unless you have some sort of insider knowledge on a stock, I don't think it's necessarily the best idea to try to get in for earning plays. That's fine if you really enjoy taking bets on stocks, but options are just inherently risky, and doing anything with them is more risk than just purchasing the stock itself. This strategy helps to alleviate some of the risk that you undergo when you trade options, because if the option price goes to zero, you lose all of the money you put in. Typically, you don't want that to happen, which is why negating risk and maybe doing a method like the wheel method, you can check my other video at that up there, would be a great way to kind of use options for your benefit, rather than just taking a 50-50 bet on earnings. Let me know down in the comments what you think of this strategy and if it's something you might test out or at least analyze a bit, maybe using Excel or the like. Let me know that down below. I upload videos on Monday, Wednesday, and Friday on travel and finance. And if that sounds like something interesting to you, make sure you subscribe down below. Thank you so much for watching, and until next time.